The world's second-largest economy, home to more than 1.4 billion people, faces problems. Rumors and concerns about China's economic stability have been circulating, causing widespread speculation and unease. Many wonder if China's economy is on the brink of collapse due to the COVID-19 outbreak or the failure of China's housing market. Let's delve into the current state of China's economy and examine whether the fears of a collapse are justified or if there's more to the story. Before we dig deep into the reason behind the collapse of China's economy, we need to talk about China's economic history. In the past, China's economy has been booming. It has experienced rapid economic growth in the past and is now the world's second-largest economy. The People's Republic of China transitioned from one of the poorest countries to one of the largest economies at a remarkably rapid pace in history. But as experts say, every economy has periods of boom and bust. Over the last 30 years, China has demonstrated outstanding economic performance, achieving consistently high growth that propelled the economy from a low income to an upper middle income level. In 2022, China's GDP was 17.9 trillion. In the previous 15 years, China has been the primary force behind global economic expansion, contributing 35% of the overall nominal GDP growth, while the United States contributed 27%. China's continuous growth can be attributed to its export connections, manufacturing industry, and inexpensive labor force. China is now in trouble. The once seemingly perfect economic bubble is about to burst. The country is facing a serious economic downturn, with decreasing growth rates and increasing debt, reaching a historic high of 288% debt to GDP ratio in 2023. The Chinese economy has faced many challenges and has not reached this position overnight. Logan Wright, the director of China Markets Research at Rhodium Group, concurred, stating, "The slowdown in China's economy is structural, caused by the end of an unprecedented expansion in credit and investment over the past decade." He mentioned that the country's financial system wouldn't be able to produce a different amount of credit expansion than it did in previous years. As a result, Beijing will exert much less influence on its economy than it has in the past. The situation was exacerbated by Beijing's unwavering commitment to a zero-COVID approach, which entailed strict lockdowns and an extensive crackdown on private businesses, significantly damaging confidence and severely impacting the most dynamic segment of the economy. COVID-19 and the zero-COVID policy caused major issues in the Chinese economy, such as the loss of job opportunities and slow economic growth. Not only that, but the real estate crisis worsened, with declining home sales of 33% since before the pandemic and a 60% drop in new construction, leading to the potential collapse of previously stable developers such as Country Garden. This housing crisis has been one of the most severe in the world over the past 30 years. This crisis has also affected the extensive shadow banking sector, resulting in defaults and nationwide protests. Some cities struggle to repay their debts, leading to reductions in essential services and senior medical benefits. Now, let's take an in-depth look at what caused China's economy to weaken. When addressing the difficulties of the Chinese economy, COVID-19 has played a major role. The pandemic severely disrupted the economy as people's movement was restricted, gatherings were prohibited, and businesses were closed. The decelerating economic expansion since the onset of COVID-19 and the uneven recoveries that followed indicate persistent challenges that policymakers must confront. On February 17, 2020, China introduced a national risk level system based on big data after 1 month of the pandemic and following the enforcement of stringent lockdown measures. The system aimed to prevent the spread of the virus within communities and minimize economic costs, a strategy known as the zero-COVID policy. This nationwide risk response system was established that required local officials to categorize communities into low, medium, and high-risk levels based on confirmed COVID-19 cases and other factors. Medium and high-risk areas implemented more rigorous containment measures, including stay-at-home orders, mass testing, contact tracing, and mobility restrictions, compared to low-risk areas, directly resulting in lower economic activity in those areas. Following the initial outbreak of COVID-19 in December 2019, the regular 6% economic growth significantly declined to 2.2% in 2020. The unexpected health crisis disturbed consumer needs, manufacturing, financial commitment, and international commerce. However, by 2021, growth rebounded to 8.4% from a notably low base in 2020. In 2022, due to the resurgence of the COVID-19 pandemic and the stringent zero-COVID policy, growth fell to around 3%. The Chinese government calculated a 3-year moving average of economic growth to mask the impact the country faced during the COVID period. The zero-COVID policy promoted by the Chinese government was presented as a global model, with claims that it effectively saved lives and supported economic growth. However, in 2022, the emergence of the Omicron variant led to the closures of financial, manufacturing, and exporting hubs such as Shanghai, Shenzhen, Guangzhou, and Changchun. This means China's zero-COVID policy failed to protect both lives and the economy. A stricter zero-COVID policy was then put in place due to the Omicron variant. This further led to a 30% decline in mobility. Based on calculations, in 2022, due to the resurgence of the COVID-19 pandemic and the implementation of strict zero-COVID policies, growth decreased to around 3%. The 3-year moving average depicts a consistent downward trend before the pandemic, followed by a sharp decline during the pandemic years. This downturn in economic activity was not only reflected in macroeconomic indicators, but also in the job market. The pandemic and the zero-COVID policy significantly impacted foreign invested companies in China. Tight restrictions and other changes due to the COVID-19 pandemic hastened the closure of foreign invested companies, including Toshiba, Nikon, and Samsung. For instance, Canon shut down its Zhuhai factory at the beginning of 2022, marking the end of its 32-year presence in China and resulting in the dismissal of 1,300 employees. By the end of 2022, there was widespread speculation on social media about whether Foxconn would pull out of China, potentially leading to a significant increase in unemployment for tens of thousands of people in Henan. In addition, during the COVID era, a significant number of private businesses shut down. For example, data from Tianyancha, a platform that gathers and distributes business data, shows that in the first quarter of 2022 alone, over 460,000 small and medium-sized private companies ceased their operations. In China, private businesses make up about 80% of the country's employment. Closing these businesses is expected to have a long-term impact on the country's employment. China recorded its highest unemployment rate since 20 years ago, at approximately 6.2% in February 2020 and April 2022. China's once thriving housing market is in turmoil. The current housing crisis has visibly disrupted the previously stable Chinese economy, causing a decrease in real estate prices and slowing down consumer spending. Large numbers of workers are leaving major cities and going back to rural areas, while millions of newly constructed apartment complexes remain unoccupied. The economic growth has dropped to record lows, declining from 14% in 2007 to just 2% in 2022, prompting many Western observers to question whether the Chinese economy is in serious trouble. China has approximately 687 cities, and the real estate sector contributes to 29% of the country's total GDP. Recently, there has been significant media attention on the Chinese real estate market, largely due to the $300 billion Evergrande debt crisis. However, this crisis is not the sole issue facing the housing market in China. A recent study indicates that approximately 20% of all urban housing properties in China, which amounts to about 65 million properties, are unoccupied. This 20% comprises substantial portions of cities such as Tianducheng, Thamestown, Binhai, and numerous others, covering hundreds of square kilometers but with significantly more vacant buildings than occupied ones. These ghost cities in China feature well-developed roads, infrastructure, skyscrapers, and a range of public areas, yet they are sparsely populated and contain extensive areas empty of residents. The decline in China's housing market can be attributed to multiple factors. To begin with, potential homebuyers are increasingly negative about their job security and future income, as indicated by a survey showing a significant decrease in the willingness to buy homes in 2024. Additionally, caution prevails in the market due to the instability of real estate developers, many failing to meet project deadlines. Consequently, This has diminished consumer confidence in the real estate industry. The last factor contributing to the real estate industry crisis is China's demographic challenges, particularly the increasing number of elderly people, which is causing a natural decrease in the demand for new housing. These factors have combined to create a severe situation, causing a crisis in an industry that once appeared unbeatable. As property values and sales continue to drop, the real estate sector's problems significantly impact the overall economy, requiring immediate and effective policy actions. Due to the real estate crisis, the industry is experiencing downfall of major players like Evergrande and Country Garden amid a broader market decline. This crisis jeopardizes domestic economic stability and presents substantial risks to global markets. The real estate crisis in China began with the collapse of Evergrande, previously the world's most valuable real estate company. Established in 1996, Evergrande catered to the upper middle class, but its excessive borrowing and overdevelopment ultimately caused its failure. By 2021, the company had defaulted on over $300 billion, and its assets were inadequate to cover its liabilities. The court-ordered liquidation in January 2024 exposed the true extent of the crisis. So why did Evergrande default in the first place? Since Beijing implemented new regulations to control the debts of major real estate developers, Evergrande has been forced to offer its properties at steep discounts in order to generate enough revenue to stay afloat. As a result, the company struggled to make interest payments on its debts. This has led to a drastic 90% decline in Evergrande's share price over the past 3 years due to the uncertainty surrounding its financial situation. Another major company in China, Country Garden, is now facing a fate similar to Evergrande's. Country Garden has been trying to avoid collapse by selling assets, negotiating with creditors, and restructuring debts. However, the company's struggle to sell new apartments has impacted cash flow, making it hard to keep up with debt payments. As a result, the company is undergoing a liquidation analysis after a petition was filed against it. These developments have rattled the domestic market and raised concerns about the solvency of other significant players, such as Vanke, which has had its credit rating downgraded to junk. The fall of these industry giants has sent shockwaves through the sector, indicating deep systemic issues within China's real estate industry. Before we get into the last part of the video, make sure to check out the link in the description for my best recommendation for further expanding our knowledge on a more personal scale. The impact of China's housing market crisis has been experienced well beyond the real estate industry, affecting the broader economy and financial markets. With property developers such as Evergrande defaulting, the resulting decline in confidence has subdued consumer spending, which is a crucial driver of economic growth. The construction industry, which is a major source of employment, has also been negatively affected by the crisis. Potential home buyers are cautious due to concerns about job security and future income. The financial markets have shown volatility in response to the unfolding events. Shares of property developers have experienced significant fluctuations based on the latest news of government support measures. Initially, government interventions were met with optimism, as seen in the surge in property shares following reports of state plans to purchase unsold homes. However, the manufacturing sector continues to contract, reflecting broader economic challenges. China finds its economy at a crucial moment. Recently, significant fluctuations and even declines in its growth, employment, and human capital have occurred. To address this instability, it is necessary to delve deeper into the root causes of these issues. So, what steps should China take? The solution appears quite clear. Put an end to financial repression, allow more of the economy's income to reach households, and strengthen the social safety net to reduce the urge for consumers to hoard cash. While there are challenges facing China's economy, such as slowing growth and trade tensions, the idea that it is collapsing is an exaggeration. China remains a major global economic player, with a diverse and dynamic economy that continues to adapt to global changes. As with any economy, it faces both opportunities and challenges, and observers should maintain a balanced perspective when evaluating its current and future economic prospects. That's all we have for today. If you like this video, make sure to give us a big thumbs up, subscribe to our channel, and turn on the notifications. And if you want to continue exploring the different economic landscape in the world, you might be interested in this video on the screen. Thanks for watching, and we will see you in the next video.